Hello everybody, Luke Gromen, FFTT. Hope you're well and had a great weekend. A lot of stuff going on, so in the interest of your time and trying to cover as much as we can, I'm going to jump right in. So first question is from NP. What are the realistic off-ramps here, Luke? For both sides, Russia faces financial ruin, West faces extreme commodity shortages and supply disruptions, taking away mutual Armageddon. Is there a path forward here for all parties? I don't know. Maybe some sort of, it's maybe a ceasefire, some sort of political resolution acceptable to both, neutrality declaration, and Russia pulls back. I don't know on the political side. What I do feel increasingly strongly about is that we're quickly reaching the point where we are past the point of no return for global markets, where supply chains, commodities, growing season in Ukraine and Russia, collapse in Russia, contagion, recession in the U.S., Europe, and the world. All of these things, I think, if we're not already past sort of the point of return on those things, I think we're very close. And so, to me, it's just not a good setup for risk assets broadly, even with markets doing what they're doing so far. Until you get great clarity on this, to me, I think gold, dollars, Bitcoin are about all you can, to me, they're the things I feel most comfortable with. Second question from GV. Now that one, Russia's financial options are limited to using gold one way or another, and two, that China sees its US dollar accounts are exposed and may try to sell treasuries, how does the dollar funding market and commodities evolve ahead, especially if Taiwan comes into play? Another question, somewhat in the same vein, from Edwin Daniel. If I understand you, this clip represents your conclusions about what happened last Wednesday night. By the way, I love your newsletter. Recommend you to all my friends. Love the non-political, honest, and brilliant analysis. Thank you, Edwin. To me, the U.S. and EU sanctioning Russian FX reserves might be remembered in time as every bit as important an event as Nixon closing the gold window. 2 Saturdays ago, the United States closed the FX reserve window. Now, some people are still pushing back that, it'll only be bad actors that get this treatment. What they are missing, and I think this is very important to understand, is the list of countries in the world that the United States has never considered a bad actor over the last 80 years is exceedingly short. So, I'd increasingly expect FX reserves and in the future commodity-related surpluses to bid for physical gold. And the important thing there is, as we wrote about in Tree Rings last week, FX reserves, current FX reserves are roughly 20 times the size of the annual physical gold production. Commodities are another 12, the oil market alone is another 12 to 15 times global physical gold production annually. Then you layer more commodities on top of that. What you quickly see is you have an epic mismatch, arguably, of FX reserves and commodities bidding for physical gold as a result of what was announced last week. So let's see how it plays out. I don't know how it plays into the dollar funding markets. I think what we've seen, I guess if I gun to my head, if you look what the Fed has been busy setting up over the last 2 years, they look a lot like the Fed setting up facilities to ensure that dollar funding markets will remain very well supplied. Standing repo facility, swap lines, etc. So I don't think the problem will show up in dollar funding markets per se, nor in the U.S. banking system. I think it's a sovereign balance sheet issue, we're seeing that in real time as the West doesn't have a lot of options, policy options vis-a-vis Russia, if any of those policy options cause a recession in the West, because that starts to cause problems with the sovereign balance sheet. Okay, next question from Mary Chapman. Hey, Mary. Hi, Luke. My question is, to what extent will higher gasoline prices impact consumer spending and add to consumer credit cards? What's the warning sign that credit's about to freeze up? In my opinion, the key thing I'm watching is total U.S. consumption as a percent of GDP. As of about 4 to 6 weeks ago, that number was just below 3%, which historically over the last 50 or so years has been the percentage that begins to foreshadow a recession. With the move we've had in oil over the last 2 weeks, we are now well above that percentage. U.S. oil consumption as a percent of GDP. So I think a recession is likely coming. Probably it starts in the EU, if they're not there already, followed shortly thereafter by the U.S. I don't think the banking system is at risk like it was in 2008. I think the issue, like I was saying, is more on the sovereign debt side. There is so little attention being paid to Western sovereign balance sheets because for 50 years they just haven't mattered. Underneath all of the noise and the rhetoric about this crisis, what is being whispered quietly now, but it will be increasingly loud in coming days and weeks, is, in my opinion, sovereign balance sheets matter. The U.S.'s options are limited because its sovereign balance sheet is such a dumpster fire. It's in the worst shape in 150 years. The EU's options strategically are very limited because its sovereign balance sheet is a dumpster fire. So I think, and when we say if the problem's at the sovereign level this time, what does that look like? Well, that looks like the central banks printing into an inflation spike. So I think that's what we're going to see. So what do? I think you still, like I said, the things I feel best about owning at the moment, given what I know, gold, dollars, Bitcoin. After the list, my levels of comfort fall sharply until we get some sort of political clarity on some sort of de-escalation. From Paul M. How can China hedge their $3 trillion FX reserves? If they don't, will the Fed monetize all of it and I guess move it onto their balance sheet? Mechanically, that's what they could or would do. I don't think China's going to sell it because as a practical matter, China's gotten rid of it on a net basis a long time ago. If you look what China's done over the last 10 to 15 years, particularly after 2008, when the U.S. showed its hand that it would print whatever needed in crises, the Chinese have been busy effectively borrowing money and spending it on finite hard assets around the world: ports, oil fields, refineries, gold mines, so on and so forth. If you're long $3 trillion of U.S. dollar FX reserves and you are borrowed $3 trillion or more against hard assets on the other side, you've sort of net yourself out. You've already effectively sold those treasuries without ever selling those treasuries. So I think that's really what has been done. Next question is from DC. Hi, Luke. The absence of the pivot to China and the China trade wars from the news flow would suggest the U.S. administration is having problems keeping all the plates spinning and is being distracted from the main game. Thoughts? Yes. I think right now they are putting out the fire of trying to overcome energy shortfalls in the very short run in an election year that's obviously being caused by Russian self-sanctions in the Western Hemisphere. So it seems like they are being preoccupied by that. I do suspect that if it hasn't happened already, there will soon be a dawning realization in Washington, D.C., that separating the U.S. from China is going to be a lot more painful and a lot more inflationary than a lot of people in Washington would have asserted just 2-3 weeks ago. I do think they're still aware of the main game, which is to say moving away from China and reshoring, but I think there's a growing realization that it's not going to be as easy as they thought. From ZP, based on your understanding of macro and everything, as a young American, should I plan on staying in America for the next 50 years or so, or would it be better to make plans and eventually move somewhere else? In my opinion, America is going to be the best place to be for the next 50 years and arguably beyond. I would say in particular areas of America that are long energy, food, water, fresh water. We're seeing energy shortages now, what that looks like. Water remains an issue globally. And so in addition, there's, as it happens, places in the U.S. that have a lot of energy, food, and water also have relatively low-cost housing, low-cost education, high-quality education for your kids. So between that, the rules of law, numerous other advantages, for me, I think places like the Midwestern and Southeastern U.S. Are likely to be amongst the best places to be in the whole world over the next 5, 10, 15, 20, 50 years. From PM, how can Powell raise more than once or twice without inverting the yield curve? And if he does that, is a recession guaranteed? Going from memory, inversion is not necessarily a guarantee of an immediate recession. However, it's been an exceedingly accurate indicator of an eventual recession historically. At the moment, I think the Fed will still try to raise once, if only for token, just to prove that they could do it. Maybe they do twice. I'd be surprised. But ultimately, continue to believe that the Fed is going to have to print money into an inflation spike sooner than expected. And what has transpired over the last 2 weeks, in my opinion, pulls forward that sooner than expected date. So we'll have to keep an eye on that. There was an article about Treasury market illiquidity this afternoon on Bloomberg. I think that's a very important indicator. We've repeatedly said over the last several years that the Fed's shadow third mandate has been Treasury market functioning. In other words, make sure the Treasury market is working well. So continue to think that's the case. Bottom line, maybe a rate hike, maybe two, but I continue to think the date of the Fed having to print money into an inflation hike is not only sooner than expected, my sooner than expected is being pulled forward by events. And then finally, from MB, how would you allocate if you were retiring in 3 months and all you had was a self-directed IRA currently valued at 25 years of purchasing power? That's a great question. If it was me, I would do 25% cash in dollars. I would do 20% gold in 1 ounce gold coins, American Eagles or Maple Leafs. I would do probably 15% in commodity and industrial related equities slanted toward the United States. I would do 25% in what I would call U.S. consumer cartels, Procter & Gamble, Coca-Cola, Clorox, Philip Morris, Starbucks, things that are relatively not that expensively valued. They're sort of bond proxies with an inflation hedge that either have pricing power due to their market share or pricing power due to their addictive nature. In the case of Philip Morris, and I would argue Starbucks as well, at least for me. I would put 13% into NASDAQ stocks, or into a NASDAQ index, since it's mostly big cap tech anyway. And then I would take the last 2% and I would put it in Bitcoin. And so with that, I'm going to finish for today. I wanted to thank everybody for joining me as usual. If you enjoyed these updates, check us out, FFTT-LLC.com, for more information about what we're up to, as well as our different product offerings. Tree Rings have been a very popular product offering. 10 most interesting things every Friday. Quick synopsis of what we're reading, what we found most interesting, and how it either fits in a picture or contradicts a picture, or why it's important. So we get a lot of great feedback on that. So in the meantime, stay well, stay warm, and I look forward to catching up with you all soon. Take care, everybody.